bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the January 20th, 2026 episode. As our audience watching the podcast on YouTube can see, my guest this week is Peter Lawrence. Peter is Novogradac's Chief Public Policy Officer and is based in Washington, D.C. Peter is back for today's episode to discuss where we stand, legislatively speaking, with regard to 6 enacted or proposed federal community development tax incentives. We're going to talk about what opportunities to enact or enhance these incentives that 2026 could bring. Now, the 6 incentives are, and if you're thinking in your mind what the 6 are, you're probably going to guess 4 or 5 of them pretty easily. The low-income housing tax credit, historic preservation tax credits, new markets tax credits, opportunity zones, those are probably 4 that you guessed pretty quickly, as well as the neighborhood homes tax credit and a real housing preservation tax incentive that we've discussed in prior episodes. Now, in listing those 6, I can't help but think that many of you in the audience might be thinking, now, Mike, we just had a big tax bill last year. We're still absorbing the permanence of the market tax credits. We're still working with Treasury on implementing the now permanent opportunity zone incentive, as well as the upcoming new tract designations. And we're still working with client and state housing agencies on implementing the lowering of the 50% test for low-income tax credit bond finance properties to 25%. So with all of that, also taking into account this year's an election year, which makes it historically more difficult to get legislation passed, you may be asking yourself or thinking to yourself, do I even need to listen to this podcast? Well, if you're asking that, let me say a resounding yes. You definitely should listen and watch. Now, the enactment of a major tax bill in 2026 is certainly highly unlikely. But that said, opportunities to advance tax legislation at various points during the year, which we'll talk about, could arise. And if those opportunities do arise, it's really important that advocates have done all of the work leading up to that to be able to capitalize on those opportunities. Also, in the course of this podcast today, I want to note that at the end, Peter and I are going to discuss the Road to Housing and Housing for the 21st Century Acts. These are not a tax bill, or these are not tax bills. However, they're legislation that, if enacted, would likely increase the amount some banks over time would invest in community development tax credits, basically increase investor demand, as well as the legislation could lower the cost of construction, or at least keep it from rising even faster, of affordable housing, thus creating more affordable housing units given the existing amount of low-income tax credit subsidy. So as you can see, there's a lot to cover. Peter and I want to discuss a lot. So if you're ready, let's get started. Peter, welcome back to Tax Credit Tuesday.
Thanks, Mike. Always appreciate the opportunity to talk to you on the podcast.
And I know you and Tony Grapponi and a few others have a bit of a competition going on in terms of number of appearances on Tax Credit Tuesday. So this is your 24th appearance. As you know, but many in our audience may not know, your last appearance was in November. And that's when you and Kevin Wilson were on to discuss an incentive that could help nonprofits finance renovation and preservation of affordable rental housing. And that is one of the 6 incentives that I mentioned in my introduction. But before we get started, and I have you, share your thoughts on the legislative agenda from a tax front at Congress this year. For those who haven't seen you before or need a refresher, please describe some of the services you provide to Novogradac clients.
Happy to do that, Mike. So we are certainly available to do various policy-related engagements. Some clients have asked us to investigate the opportunity of a particular legislative proposal to create or modify an existing resource. And we're certainly more than happy to do that. We're in the process of finalizing such an engagement as we speak, and always open to other ones. We've done several in the past. So if you have a policy issue that you think needs a federal fix for, please reach out. We're more than happy to work with you on such engagements. But of course, the other one is various working groups, which, we have 7, most of which meet monthly with updates between each monthly call on various key developments. And I'm not going to go through every single one of them because I want to get to the meat of the podcast soon, but all the various incentives, the low-income housing tax credit, new markets, opportunity zones, each of them has a working group that brings together a variety of cross-sector stakeholders that care about what the incentive is all designed to do. And if you're interested in joining one of our working groups, we're more than happy to have you join that working group. But I think I'll leave it at that for today, Mike.
Great. Thank you for that, Peter. So you heard my introduction and you know why you're on the podcast. Please share for our audience some of the reasons they should be paying attention and staying engaged at the federal legislative front this year, given that major federal tax legislation isn't likely in 2026. And I want to emphasize major federal tax legislation isn't likely in 2026. I think some tax legislation is probable in 2026.
Indeed, Mike. And as you point out, One Big Beautiful Bill Act was a huge piece of generational tax legislation. And when you talk about several $1 trillion worth, it had, many provisions. Of course, you mentioned the 3 that directly impact our line of work, but there's lots of other ones as well. And given that, Congress doesn't do tax legislation all the time, it's typically, there needs to be momentum building up towards advancing, especially big ones. And with the fact that most of the major issues were handled in One Big Beautiful Act, all the various things that major tax provisions that were expiring last year or expiring soon were addressed. And so it's not terribly likely, but there are certainly opportunities that may be on the horizon, and you have to be ready for those if they ever develop. If you wait till all the sort of stars line up in Congress, it's too late to affect that legislation. Often that's pretty much whatever the deal is cut at that time, it's a done deal. So that's why you need to be prepared and get ready and sort of look ahead for these options as they may develop. And also, these opportunities might come with new resources that weren't addressed in the reconciliation bill. And one example you talked about is the preservation of rural housing tax incentive, which we often use the shorthand of the bill title that we expect when the bill is introduced, the HOPE Act. So you want to be really dialed in ahead of time so that when an opportunity to advance those resources comes up, you can act and take the best advantage of.
So whenever we're talking about tax legislation, we instantly start talking about automobiles, or at least vehicles, various vehicles or to ride on. The areas that we're focused on, there's to be generally, you're not going to get one piece of tax legislation and one narrow item passing somewhat in isolation. No, that can't happen. It did happen at the end of last year on a more minor administrative sort of tax issue. But there are always potential vehicles that you going into the year, you don't know if something's going to materialize. In the past, you always think of extenders as being something. You always think of potential disasters and needing a tax bill there, or some other economic or other event that warrants a tax legislation response. So we talk a bit about those as well as other possible vehicles that you could see possibly arising in the course of the year.
Yeah, I'm happy to do that. But just before I do that, Mike, I do want to just note, because we do get that question all the time. Why can't a bill just pass on its own? Why does it need, a vehicle? And I think there's a couple of reasons why. One of them that we sort of been alluding to, and that is you need a concerted push with a lot of different issues. And a single bill typically might not have enough of a sort of momentum behind it in order to get through. But the other reason is there's something called pay as you go, which I know some people think, really, does Congress really pay as you go? But it does affect how tax legislation is approached. And that is basically when you have tax legislation, it typically needs to, unless Congress decides otherwise, to be paid for. And that basically means that if you're passing tax legislation that reduces tax revenue, you either have to have something that cuts mandatory spending, or increases revenue elsewhere in the tax code. And often the case, the real challenge is finding those acceptable pay-fors. It's not easy to do those. Those are often sometimes a lot harder to find consensus around to do. And so that means typically you need a large enough tax bill with enough people with interests behind it to get that momentum behind it and also find acceptable pay-fors that sort of are justified to address the major issue that the tax legislation is designed to address. So that's, I think, part of the reason why. And because I feel like I need to give this public service announcement on that front, given how often we get that question. But
and I just would actually layer in there that kind of in addition, when you're looking at a single item, a single issue, the chances that, a substantial majority of the House and the Senate care about singularly about that one issue enough to say, okay, I'll let it pass alone, as opposed to saying there's 5 other issues I care more about. And if this other issue is going to get addressed, I want my issue to get addressed too. And then the Christmas tree starts getting ornaments put on it. And then, it becomes more challenging. So I appreciate the pay for part, but also just the general politics of various priorities that members have, and getting them all or enough of them on the same page to pass is more challenging. But please talk about some of the possible vehicles.
Happy to do so. So typically that larger vehicle that sometimes your one single issue catches a ride on, there's 2 main opportunities we see. One is yet another reconciliation bill. People may forget, but soon after the ink was dry on the OBBBA Act, leadership in Congress talked about potentially have a second reconciliation bill, and one that would potentially have tax provisions associated with it. And you may ask, well, Peter, what would drive that second? I thought you just talked about how One Big Beautiful Bill had everything. Well, not everything did make it in. And so as part of the process, often leaders say, well, we can't address you in this reconciliation bill. We'll let you get your issue done in the second one. So there continues to be chatter about this. And in fact, the Republican Study Committee this month released their priorities, which was remarkably tax heavy. And actually not only tax heavy, but housing tax heavy, not necessarily the issues that we're talking about, but the mere fact that the largest sort of caucus of House Republicans came out with a package that talks about reconciliation, including housing tax proposals, is, I think, an indication that there is an opportunity potentially for things more along the lines we're talking about in a reconciliation bill. Despite that, it is going to be very difficult to do a reconciliation bill. The main reason why is that the partisan margins in House actually continue to shrink. It's this entire Congress, the 119th Congress, there's been a very tight margin in the House, and it's gotten even tighter. There are currently 2 Republican and 2 Democratic vacancies, so 218 to 213. And tie votes in the House are a failure. So that's a 2-vote margin. And soon, the vacancy in one of the Democratic seats, 18th district in Texas, which is centered around Houston, there's a special election to fill. It's going to be almost certainly a Democrat. So we're going to go to 218 to 214. And there also are the situation where there's one particular House Republican that never voted for any of the steps in the process for reconciliation or on big budget legislation, Thomas Massey from Kentucky. So really they have a 1-vote margin. And you've got to get everyone on board, sometimes with various controversial items that perhaps some House moderates might not like, or some provisions that House conservatives may not like, all to vote with only 1 vote to spare. That's a really tough job to do. And we've seen a couple of unexpected failures on the House floor this month when House leadership miscalculated the votes. That's really why it's going to be a challenge to do reconciliation. So if it's not reconciliation, the other option is a bipartisan tax bill. And the obvious one is the one that's sort of dominated a lot in the past few weeks and months, and that is legislation to address the now expired Affordable Care Act premium tax credit subsidies. That was one of the major reasons why we had a shutdown late last year, the longest government shutdown on record. And when the House returned this month, they did vote out a 3-year clean extension of those subsidies, albeit almost virtually with Democratic votes, with 4 defecting House Republicans. Well, sorry, that they signed the discharge petition to get the bill forward, and there was more votes actually on the actual vote there. But in any case, that technically is a piece of tax legislation, and there is a sort of bipartisan group that's trying to find a way forward on that. And there's could be a possibility that other tax proposals might catch a ride. Although I will say, I think it's given how challenging a negotiation it is, there's a good chance that it falls apart entirely and nothing advances. I think leadership will want to try to keep it exclusively focused on healthcare and not have other tax items on it. But we'll just remains to be seen, and we'll of course keeping an eye out on that. And then there are a couple of other issues like tax incentives. You mentioned that before. There were a few provisions that weren't addressed in the One Big Beautiful Bill, like the work opportunity tax credit, and that could potentially be brought up. I'd say that's most likely for a post-election lame duck session. And so you can't wait until after the election to start advocating on these sort of things. You want to take advantage of the year so that when you have that opportunity, you can take best advantage of it. And then a couple others, crypto taxation is a hot topic item. There's this legislation that was introduced by Representative Max Miller from Ohio. And we're keeping an eye on to see if that develops and gains some momentum and potentially has other things added to it. And then lastly, there is tax administration and technical corrections, which again may be a lame duck item. But those are the main potential tax legislative vehicles we're looking at.
And I would note as part of the sort of the technical corrections, which usually really isn't a technical correction as much as a reversal, there's the 90% loss limitation for gambling losses. That's very important legislation in the state of Nevada and for some others. And you hear that talked about a lot in terms of trying to roll back that 90% overall limitation. And then, as I mentioned, there's also kind of the disaster. If there was some natural disaster that might warrant a tax response in addition to other support. And then there's always the unknown. We've definitely had situations in the past where something arose that came out of nowhere and it wasn't really foreseeable. It was definitely kind of a black swan, but that's yet one more reason to be staying engaged to see what ends up coming down. So let's now turn to the 6 areas that I wanted to cover before we get into the housing bill, the non-tax related housing bill that I want you to share some high points for our audience. And in looking at the 6, I was thinking, which one should we talk about first? And I couldn't help but pick the historic preservation tax credit. The historic tax credit is actually the first tax credit I ever worked on before the Tax Reform Act of '86. So it was many moons ago. And the historic preservation tax credit, of the 6 items, the 6 taxes that I mentioned, it's the one that has been enacted but didn't get any enhancement through the One Big Beautiful Bill Act, through OBBBA. Please share with our audience the current status of advocacy efforts on behalf of expanding the ability of the historic tax credit to be used to preserve America's architectural heritage.
Happy to do that, Mike. So, the Historic Tax Credit Growth and Opportunity Act has been, the key historic preservation tax legislation community has rallied around for several Congresses. And despite the really best efforts of Senator Cassidy, the leader in the Senate, on HTC Go, they unfortunately just missed the cut. And I think, it's often the case in these sort of issues, whenever something comes just short, the next opportunity comes down and you're more likely, given those efforts, you kind of want to keep the sort of momentum going. And when leadership says, no, we can't afford to include this one, we're going to help you the next time down the pike, you want to be prepared and ready for that. And I think there's a lot of reasons why there's good support in Congress more generally, but not everything can make it. So I think Senator Cassidy is getting things sort of rallied up and ready so that if there is another opportunity, he can take advantage of that. And I think the other thing we just need to point out is that it is ripe. It hasn't undergone true, modernization efforts since 1986. There was some significant guidance that was issued a little bit over a decade ago. That plus the fact that in Tax Cuts and Jobs Act, it was changed from a 1-year credit to a 5-year credit, and that has sort of eroded the value. I think community has rallied around proposals that are designed to sort of turn that around and make it more attractive legislation. And I think it's worth noting here we are in 2026. It's the 250th anniversary of the U.S. And I think a lot of folks want to leverage that anniversary as a reason to take actions to help support our history, and historic tax credit is our key way we help preserve historic properties in the country. So we're hopeful that the next opportunity we get, we'll take it. We'll be able to take advantage of it.
Great. Thank you for that, Peter. And I will say to the audience, hopefully you're interested in getting engaged and staying engaged in this area with respect to the historic tax credit. I'd encourage you to join the Historic Tax Credit Coalition. That's the organization that you can be getting monthly updates on the status and the efforts. And you can also basically leverage the work that you do by adding to the work that they're doing. And I will include as a link to the show notes, the Senate Finance Committee testimony that you helped me with that was submitted to the Senate Finance Committee that has a good section on the historic tax credit and talks a bit about, the challenges historic tax credit has faced in recent years, given the various legislative and judicial and administrative rulings that have come out that have slowly kind of eroded the value of federal credit. But let's keep going. We have a lot we do want to cover here. The next item that I think is worthy of discussing of my initial 6, and then thinking about this, I might be adding a 7th, is the neighborhood homes tax credit. That is legislation. It's been introduced. There was an effort to have it be included in the One Big Beautiful Bill Act. Unfortunately, it was not included. Where are we with the Neighborhood Homes Investment Act?
So it's one of the, community development tax incentive proposals that has a really good existing base of bipartisan, bicameral support. And I will say the political moment is really, the atmosphere in Congress. It's a lot of attention on housing affordability, especially for home ownership. The administration is rumored to be planning an executive order focused on housing affordability, especially for home ownership. There is, I think, there's new reports coming out. The National Association of Realtors found that the median age of a first-time home buyer reached a new high, age 40, which raised a lot of eyebrows in Congress. And really what this underscored is that we lack a supply of single-family housing for home ownership in this country. It's just not produced nearly to an extent that it used to be. And this is one of the proposals that's best designed to address that supply deficit. It really combines features from the low-income housing tax credit, like it is administered by the state housing agencies, just like the low-income housing tax credit, but it also shares some features of the new markets credit, which to some very limited degree has been used for home ownership. And it really would help, I think, create an infrastructure leveraging the best of the housing credit in new markets to address this national need. And while it's not going to be, we talked about how challenging tax legislation is, I think of all the things that Congress is really focused on these days with affordability, this is one that I think rises to the top and has a good chance of leveraging the attention that homeownership is getting these days. And I also just want to note, for those who are interested, we do have a working group that is monitoring the details and designs it so that if and when Congress, does enact it, we'll be ready and work with the states to implement this great new resource. And a lot of work needs to wood to be chopped to be able to stand up a new program, and the working group is really well positioned to take advantage of that.
And just as I mentioned, the Historic Tax Credit Coalition for the historic tax credit, for the audience members who are interested in this particular incentive in working to get it enacted, as well as learning more about it. So once it's enacted, you can hit the ground running. I do encourage you to join the Neighborhood Homes Tax Credit Working Group that we have here at Novogradac. And we'll include a link in the show notes to all the various working groups so that you'll have that at your fingertips. And also emphasize what Peter was saying, that the new market tax credit, is used for home ownership. And we have a session at our upcoming New Market Tax Credit Conference later this week in San Diego, specifically on that. And there was a recent podcast that my partner Nicole Pinoli and I recorded that also talked about that. So that is an existing resource that does do that. And there's been some talk of, we've had some clients attempting to do that through opportunity zones, and that ends up being probably on the most part more rent to own model because of some various structural issues. But let's move on, keep going here, and talk about the HOPE Act. And this is the act that's not been introduced yet, but we think it'll be introduced soon. You can share whatever you know about that. And this is a tax incentive that would raise equity from individuals. Individuals would be investing for tax loss benefits, and that capital could be used or would be required to be used to renovate existing or converted affordable rental housing. So if you could talk about the HOPE Act.
Happy to do so, Mike. And, it really, I know some people have thought, hey, Peter, just had this tremendous permanent expansion of the low-income housing tax credit. And isn't the housing credit also used in preservation? And yes, it has. And it is absolutely a key resource. But we have such tremendous preservation needs in the country that even an expanded low-income housing tax credit can't address it all. And so this proposal is really designed very much intentionally to be a complementary tool to the housing credit. It's targeting a different set of investors. The low-income housing tax credit, the vast majority of investors are corporate investors, while this proposal, sort of like opportunity zones, is targeting individual investors more so. And it's also designed to really address the needs beyond which the housing credit can address. And really, we hear routinely of a lot of nonprofit owners of affordable housing that are forced to sell because they can't find resources either through a housing credit or elsewhere to address their aging stock. And, the National Housing Preservation Database has predicted that there are at least 500,000 federally assisted units that are scheduled to expire one way or another, for either through housing credits, affordability use period, or federal rental assistance contracts, a variety of different ways that these properties will come up from their affordability use periods. And so the need to preserve those is tremendous, and that we need more tools in the toolbox to address that. And this is, I think, the major motivating source behind the HOPE Act. And as you noted, Mike, we also have a working group associated with pushing that proposal forward.
No, excellent. And I would, emphasize that one of the inspirations for this provision is just looking at the success opportunity zones had of raising over $60 billion of investment from individuals, a large portion of that going into workforce housing. So this is a way of just trying to capture that individual investor pool that pays substantially more taxes than corporations do. It has a higher marginal tax rate. So it's definitely a resource opportunity that we need to develop legislation to tap into. And this is a great way to sort of begin to do that. So I mentioned that I might go a little bit off script and add an incentive. Well, I think I'm going to add 2 more incentives. So this is bonus. I didn't say the bonus for the end. We just went from 6 to 8. And the first of the 2 bonus tax incentives that have not been enacted yet, but have legislation that's been introduced in the past. So it's something that's pretty serious. The first, the workforce housing tax credit. Please describe what that is roughly at a very high level and the status.
Yeah, this is legislation that's been introduced in previous Congresses. It's not yet for this one, but we anticipate it could be later this year. And really, it's even more so than the neighborhood homes credit pattern after the housing credit. It adopts almost the same whole regulatory infrastructure as the housing credit to allocate by the states. It can be used to finance rental housing up to 100% of the earned income. And some people will ask, well, Peter, do we really need that? And it's not something that every market needs, but a lot of high cost markets, folks earning 100% of their earned income simply can't find affordable housing, especially close to their jobs. And it's really the way this legislation has sort of evolved over time has been to make it very flexible. I mean, states essentially it's a separate pool of authority. They could choose to use it entirely for housing credit purposes or for workforce housing, depending on their particular markets. Any particular year, they could choose to go back and forth on this. And it also could be added to subsidies in any one property. So you could have, say, in a 100-unit building, you could have 75 units of housing credit financed and 25 of workforce housing credit to provide really sort of a mixed income property. And this would be completely up to the states to decide how to do. And I think that additional flexibility is something that we constantly hear is needed to address some of the needs that can't be addressed by the housing credit alone. And Colorado has even taken the step of creating a state workforce housing tax credit, very much designed similarly as this federal tax credit would be. So I think it's not clear exactly what its chances are in future tax legislation, but it is something, and it has the support of the top Democrat on the Senate Finance Committee, Ron Wyden. He is a pretty influential tax writer, and one could imagine if housing tax legislation is gearing up, he'll want to try to push for his priorities in it, and this could be one of them.
Thank you. And this tax credit is also outlined in my written and submitted Senate Finance Committee testimony from a while back. So that'll be in the show notes, along with, which was also in my written testimony, was the Downtown Revitalization and Main Streets Act. So if you could describe for our audience what that bill is intended to do.
Yeah, this is a bill that really has been designed to try to address the post-COVID work in office situation. I think ever since the pandemic, there's really been a change in how people work, and that people are not necessarily, of course, not everyone. There are folks who go in the office 5 days a week, but many people are choosing to work more and more from home. And this is being reflected in the fact that a lot of commercial real estate, including office properties, are showing a lot of distress and potentially, serve as a huge tag on economic growth and problems in many cities. And while at the same time, we have this huge problem with affordable housing. So this proposal is really sort of designed to try to address both of those problems in one fell swoop. We'd authorize, $15 billion of tax credits that would go once again to state housing agencies that could be used to convert commercial real estate into affordable housing. And it shares a lot of features of the historic tax credit, Mike. So they're definitely borrowing from that playbook and it could be combined too. If it was an historic property, you could use both. The historic office property, you could use both historic credits and this new proposed conversion credit to create affordable housing. And, a lot of the major housing lobbies, which have a decent heft in Congress, like the National Association of Realtors, the National Association of Home Builders, and the Mortgage Bankers Association, they're all strongly supportive of this idea. And so it could find a home with some tax legislation.
And in these two, the workforce housing tax credit, as well as the Downtown Revitalization and Main Streets Act, if our audience is interested in these two, I'd encourage them to join the low-income housing tax credit working group. We don't spend a tremendous amount of time on that working group on these two areas, but it's something that we're constantly staying current of and updating. And at a minimum, they could be asking you about it every month and sharing information about it. So let's turn now to the 3 community development tax incentives that were big winners in OB3 last year. And of course, I'm talking about the low-income housing tax credit, the new markets tax credit, and opportunity zones. When I think about low-income housing tax credit, I think the Affordable Housing Credit Improvement Act has many provisions, nearly all of which were not enacted as part of the One Big Beautiful Bill, which is not to say that we're not grateful for the lowering of 50% test down to 25% and the 12% increase in 9% credits. Those are big and powerful and generational in terms of support. But there are a number of other provisions there. Same thing with new markets tax credit. It's not inflation adjusted. Individuals can't use it to offset the alternative minimum tax. There are a number of ways in which new market tax credit could be enhanced as part of a tax bill. And then, of course, there's opportunity zones. And there were many asks that our opportunity zones working group submitted, many of which were adopted, some of which were not. So there's a laundry list there as well. With respect to these three incentives, please share with our audience how you see the lay of the land over 2026 in terms of legislative changes.
Yeah, again, if there is a, tax legislation that has momentum, the various proposals that didn't make the cut might find a home. And then one I'll take particular with the housing credit is one that actually was included in the initial House version of the One Big Beautiful Bill Act, and that is the rural and Native American basis boost. So that proposal was, the rural basis boost, that was included in the House version. And I think given that fact that it did pass the House with strong Republican support, does position it well in any future tax legislation. It would essentially make all non-metro counties plus the rural areas of metro counties designated as difficult development areas and eligible for up to a 30% basis boost. There is also a similar Native American basis boost, and the proposal to extend the same discretion states have on the 9% side to provide up to a 30% basis boost if needed for financial feasibility to ones financed with private activity bonds. And those are all, I think, in the mix, as well as the proposal to provide up to a 50% basis boost for units serving extremely low-income households, which would make it easier to finance housing for the homeless, among other populations. So those are the various proposals there. I think that there still is, again, we mentioned, the issue of housing affordability is first and foremost in Congress's mind, and these are very widely supported parts of the Affordable Credit Improvement Act that could find a home. And then new markets, you mentioned that, Mike, indexing for inflation, being able to take the credit against alternative minimum tax liability, which would help further increase individual investor demand for the new markets credit, and allowing for no basis adjustment to adopt the same policy parity with a low-income housing tax credit, and ultimately being able to generate more subsidies to the businesses assisted with the new markets credit for every tax credit dollar are things that I think could make the cut in future tax legislation. On opportunity zones, we came close with a few ideas like interim gains, allowing folks to reinvest gains in funds rather than triggering capital gains. That would be really particularly helpful for operating business to use opportunity zone equity to assist operating businesses, or merit income rather than just forcing only those with capital gains to invest. That's something that came close but didn't get across the finish line. And housing affordability, housing related, make it easier to use opportunity zones for affordable housing. Those are all proposals that might find a home in future tax legislation.
Thank you for that great overview. Obviously, it's just an overview. A lot of it is sort of provisions embedded in there, and it's always hard to talk about these because I'm sure members of our audience or either want proposals there are more of concern to them that you wish Peter had mentioned as opposed to the ones that were mentioned. I'll note on the opportunity zones, we believe that Treasury has the ability through regulation to allow for interim gains not to be recognized if reinvested. We think that's what the original intent of the bill was. We think there's statutory language that supports that. And the question is when that Treasury has the will to do that or not. There's a number of other suggestions that our Opportunity Zones Working Group made on the opportunity zone legislative front. So I'd encourage folks to join the working group as well as go to the working group site and look at some of the various recommendation letters. And I was going to go on a tangent about NMTC offsetting the AMT liability. I think that would be pretty powerful in terms of expanding the investor base for new markets. But I can't, in the back of my mind, I'm just thinking there's some accountants and tax attorneys out there saying, well, technically, the new market tax wouldn't be offsetting the alternative minimum tax. There's something called a tentative minimum tax. And that rings, and the reason why that's so significant to me is when I graduated from Berkeley in my tax class, one of the questions I got wrong was mixing up tentative minimum tax and alternative minimum tax. Which you probably didn't know, Peter, and probably didn't need to know. Certainly the audience didn't need to know that. But it's just funny. Every time we talk about new market, that kind of triggers me that I made that error with tentative minimum tax versus alternative minimum tax. And if anybody wants to know what all that was, email me. Let's move forward, Peter. Let's talk now about the Road to Housing bill that came out of the Senate and the Housing for the 21st Century Act, which is House legislation. These are banking related bills. Please explain to the audience how, if the right provisions in the bills is enacted in a bill, how that could increase the level of interest for some banks, maybe many banks interested in investing in tax credits, as well as the impact it could have on the cost of housing construction.
Yeah, and really, I know we have to go through very quickly this. We could do a whole podcast just on this legislation, given the road has like 60 provisions associated with it.
Was that a suggestion, by the way?
But we don't have time for that today.
No.
I want to highlight a couple of things that where both the House and Senate legislation have this provision to increase public welfare investment cap that banks have. And in general, banks don't make equity investments, but there's a few exceptions to that. And one of them is the public welfare investment, which really is the key source of authorization for banks to make low-income housing tax credit, new markets tax credits, and to a lesser extent, historic tax credit and renewable energy tax credit investments. I mean, in general, banks are allowed to invest up to 5% of their capital and surplus in these public welfare investments. And they can go past that 5% up to 15% with regulator approval. This was last addressed back in 2006 when the cap was increased from 10 to 15%, where we are today. And over the course of that history, banks went from making about $3 million in public welfare, $3 billion in public welfare investment in 2006 to just short of $29 billion in 2024. And that's quite a remarkable evolution. And that was really triggered by Congress's action to increase the cap from 10 to 15. And the Affordable Housing Tax Credit Coalition and others recently conducted a survey of banks to see where are they now with respect to that cap limit? How many are approaching that 15% limit, which is a hard limit there. It can't go beyond that. So if they're approaching that limit, they essentially have to start selling their portfolio on the secondary market, which doesn't help increase new affordable housing. We want to be able to take advantage of bank investment for that new production. And this proposal would increase it further from 15 to 20%. That doesn't mean that all banks would automatically go to that 20% limit right away if enacted. And there's a whole slew of other parts of the analysis, but it would remove one key barrier on some banks. And the survey found that about 40% of banks are reaching, 2/3 of all banks making housing credit investments respond to the survey. And so we don't know about the other third, but could be even more so, right? A higher percentage amongst that. So this has a potential to removing a key barrier to corporate investment among banks. And that's why we're really hopeful of that. And again, we don't have time to go through all the many other housing related provisions in both the House and Senate bills, but there's provisions to address home reform, which there was a little bit of concern whether Congress was ready to fund home. At one point, the House proposed zeroing out home funding. And so the fact that key reform pieces are advancing in both the House, Senate really bodes well for home and with reform, I think you can take better advantage of the resources that Congress does provide to produce housing. And in particular, it helps address some of the federal cross-cutting requirements like the National Environmental Policy Act and the Build America, Buy America provisions that help increase the cost of development. So we're hopeful those get across the finish line. Again, given the Congress's attention on housing affordability, it does seem like there's a good chance. It passed the Senate Banking Committee 24-0. That's all members of the committee voting, no opposing votes. And it passed the House Financial Services Committee 50-1. Those type votes are not very common these days, Mike.
They are not.
When they happen, you take notice because they demonstrate really strong bipartisan, bicameral support. So we'll see how that legislation develops.
So before we wrap up, I wanted you to share any additional thoughts that you have with our audience, be they developers, investors, syndicators, attorneys, consultants, lenders, the like, what they can be doing now and should be doing to prepare for an advocacy push. How do they stay current and targeted? And we mentioned the various working groups that we have, which we'll list out in the show notes. And you and I will be in San Diego at our New Market Tax Credit Conference, and we'll have 700 plus or minus community development stakeholders there to help celebrate permanency of New Market Tax Credits, help celebrate the new $10 billion round, as well as to prepare for the next application cycle. And then we'll have a conference, a affordable housing conference coming up in May. And then our various other conferences will be coming along during the year. So that's another good resource. What are some other resources, or feel free to expand upon the ones I listed?
Yeah, absolutely. I want to just double your recommendation to join the working group. If you're interested in any of these one areas we mentioned, the working group is often the best way to keep engaged, know what's happening list, and how best to engage with members of Congress on that specific issue. But in general, just sort of in general, I think the one thing to keep in mind is Congress really wants to hear from constituents. And so if you have investments in their home state or home district, you should invite them to visit. That is often the best way you can advance a lot of these proposals. If you have a housing credit property, invite them to visit. It doesn't have to be groundbreaking or a grand opening, although those are two definite classic ways you can bring a member of Congress to visit. But it can be, say you've got a property that's coming under its affordability use provision that could be assisted with the HOPE Act and helping preserve it. That's another great way to visualize what exactly this proposal might be able to help save. And so, really members of Congress are driven by what's going on in their home district and states. And so the extent you can bring them and show them your housing investments, your community development investments that you're doing, that makes it much more likely that they'll support legislation designed to advance these than any amount of lobbying alone in DC can do.
Excellent. Very thorough as always, Peter. And I know there is so much that is left on the cutting room floor, if you will, much of which is in my Senate Finance Committee testimony, because that is relatively lengthy. I won't say it's exhaustive, but it's definitely approaching being exhaustive. Please do stick around for the off mic section. Before we get to that, I want to turn to our audience and encourage you to subscribe to Tax Credit Tuesday on whatever platforms you get your podcasts. Also, I encourage you to take a moment to like and comment on the episode. That helps raise our visibility, helps others find the podcast, and encourages us to keep doing the podcast. And we also encourage you to share our episodes of Tax Credit Tuesday with your colleagues. It's a great way to learn about a topic, stay current on a topic. There are a large number of podcasts on a wide variety of topics. We even have our renewable energy and light tech finance series where you can basically binge watch to get up to speed, which is great for new staff and the like. And I also encourage you to submit any questions you have about the podcast, any suggestions you have about future topics, any good words you want to say about the podcast, or even some criticisms to CPAs@novoco.com. And now let's turn to our off mic section. It's a space where my guest has an opportunity to give a shout out to someone working in one of the tax credit or tax incentive communities that we serve here at Novogradac to highlight a professional worthy of recommendation. So Peter, who would you like to shout out?
Well, I'd like to shout out, Mike, given that you mentioned our New Markets Tax Credit Conference in San Diego this week. We are very happy that Alex Smith, the Deputy Assistant Secretary for Community and Economic Development, and the acting CDFI Fund Director will be providing a virtual keynote at our conference. And we've been really happy to work with her, really glad that she is very much engaged in the future of the New Markets Credit and CDFI programs in general. And we're very much looking forward to what she has to do and working with her as we help plan out what a permanent New Markets tax credit will be. And so that's who I'd like to have for our shout out this week.
Well, I echo that shout out as well. Alex is a real voice for community development and positivity with respect to New Market tax credit and beyond that with the CDFI fund and the like. So I'm super excited that she's going to be joining us virtually at the conference later this week and excited to hear what she has to share. Peter and I, just to be clear, will both be at the conference. I will be moderating the Watch the Wire panel. So if you're listening to this podcast and you're attending, please come up and say hello to me and to Peter when you find us in the crowds or after we speak. So thank you, Peter, for being on the podcast today. It's always a pleasure.
Thank you again, Mike.
And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.